Good afternoon and welcome to this month's Market Happy Hour. I'm Bill Bynan. I hope you are all well and getting back to a normal life. I know Naples and Florida still, although it's been great, seems to be opening up and people are getting back to normal lives. So we're hoping you are as well. Um, as always, when you logged in, we have our web disclaimer that asks that you don't record or share the information without our approval. So keep that in mind today. Thank you very much. Today, we're going to have our normal speakers, myself, Bill Bynan, President CEO of Capital Wealth Advisors, my partner, Lewis Johnson, who is our Chief Investment Officer, and our Director of Research, Zev Abraham. Kevin Erndl could not be with us today, so the three of us are going to run with the ball. I think you're going to find today's topics pretty interesting and how we're adjusting to a new world. Before we begin, as always, we have questions and answers available to you. We've already had one come in, so thank you. So if you have a question during the presentation, feel free to enter it in the Q&A section. We'll get to as many of them as we possibly can. If we happen to miss your question, we will reach out to you afterwards with a direct response. And at the end of the surveys, or end of the presentation, if you'd be so kind to complete our exit survey. This is a way that we can get your feedback and gather information on topics and information that you'd like to hear in future sessions here at Market Happy Hour. So today we're really going to talk about changing a portfolio in a changing world. As the world changes and cycles roll over, how do we really look at our portfolios? Changing worlds require changing portfolios. It's not a set it and forget it world. So we're going to talk about old world versus new world. And when we talk about that, one of the key things that we're going to discuss today is the fact that we are coming out of a 12-year long cycle of a strong dollar, and we're shifting with the global stimulus and the amount of money being pumped into the global economies to a weaker currency, weaker dollar situation. And how do we adjust that in our portfolios? We're going to dig deep into our changes. We're going to talk about what we're doing to better prepare our portfolios for success in this new world. We're going to talk about our long view. We'll talk about interest rates. We'll talk about commodities and where we feel that is, and then how that plays into our model changes. And with model changes, we always have to be aware of changes in tax implications and how those are going to also affect the portfolio. So at the end of this session, we're going to dig a little bit into taxes, which have been top of mind for many of you. Gotten a lot of feedback as we're seeing the proposals from the current administration. So I'm happy to have Lewis kick it off with us today. And remember, don't forget to ask your questions along the way this afternoon. Thanks.
Hey, Bill, thanks for the intro, and thanks everybody for taking the time to join us to kind of hear our thoughts on kind of ever-changing markets. And hopefully, we've got some good information for you to help you understand kind of the environment that we, foresee, how it's changing, what we think the best investment philosophy and positioning is going to be for us in our portfolios going forward. But before we kind of get too deep in the weeds, I just wanted to hopefully kind of put this into context or maybe give an example. It's just the way I kind of think about this is it's kind of like money and kind of people are similar in a few aspects, right? As Bill said, Florida's, reopening. There's quite a bit of kind of inbound immigration. People seem to be, or at least certain people seem to be kind of flocking toward the more open environment, where there's a little bit more freedom of motion and initiatives rewarded anyway. But, capital is kind of like that. Money flows to where it's kind of respected, where there's the chance for it to earn the highest return, kind of where it feels, safest, has the best, opportunities and safeguards, and where growth is the best, And so really what we're talking about in a number of details, kind of slide after slide, really has to do with the fact that some of the changes that we're seeing now in the States, I think, unfortunately, are kind of creating an environment that's a lot less hospitable to higher returns on capital, people's kind of after-tax wealth. And in my experience in the investment markets, when markets do respond to incentives. And so if we're really kind of finding an environment that's becoming increasingly less accommodating, even for, socially justifiable reasons and so forth, that really can cause a shift in the markets. And if so, then our investments need to shift accordingly. So that's really what we're going to be talking about today. in a host of details, but don't let that big picture example slip from your mind. So what I would just say again, kind of big picture, keep it really simple. There was an old world, which is the way things I suppose used to be. Then there was COVID, and then there's the new world. And so we think that there are a couple of aspects of this we want to do a bit of a deep dive on. But the bottom line is that there was the old world and there's the new world. And here we just wanted to contrast for you, big picture, some of these changes that we think are out there. So for instance, in retrospect, clearly there were at least 4 areas that I would say were more kind of capital, investor friendly, growth friendly, and frankly, I think we're in a world that's decidedly less so, and that can change people's incentives, and it can change the way kind of money can go to seek out its higher return. It can set incentives for us where we need to kind of act upon that if we're really going to do. Our goal is to find the best risk-adjusted ideas in the markets. So one way to think about this is just, we've talked about kind of taxes, and there's a whole host of new proposed legislation that we keep hearing bits and pieces of, and it seems like there's kind of a new sheriff in town when it comes to thinking about tax regimes and regulation and so forth. Those changes are important because they change people's incentives, and incentives drive activity. And so we think that's a change, number one. Number two, in terms of globalization, there's a couple of examples I think we'll be able to cite, real world examples where the world does kind of continue to go through this deglobalization process. For a while, I think that in the early phase, that probably benefited the U.S. as a more defensive location. I could argue that perhaps that's changing. I'll give you a few examples of that. And another aspect of this really has to do, it seems like our relationship with China, which is, kind of looming now as a potential, rival, to the U.S. and the kind of power system that we frankly instituted for our benefit after winning World War II and set up all, NATO, the UN, the WTO, all these things that really were meant to kind of enshrine U.S. and global leadership. Those are kind of fraying around the edge, and this is having many investment manifestations. We think this is all part of the same trend. We'll talk about that. And finally, kind of what this might mean for the dollar is this could be a set of items that's really creating kind of less demand for the U.S. dollar relative to the demands that were placed upon it in the past. For 2 reasons. Number one, perhaps if the U.S. is becoming more capital unfriendly, it's a lack of a positive there, and frankly, valuations outside of the U.S. are meaningfully lower, which creates kind of a better risk reward from an initial perspective in terms of new money. So anyway, these are kind of the 4 big things we're going to talk about. Just give you a couple examples of each, but we really wanted to highlight and say, this one way to think about this really big picture really has to do with incentives, people's expectations for growth, what they're paying for that growth. And that's why we think we're starting to make some meaningful portfolio changes, and why we think, frankly, there's more to come. So one item we want to talk about, again, to try to contrast both the old and the new world, but just a few examples, of course. These always kind of go without saying. Certainly the prior administration had a bias towards, tax cuts and so forth. Those were implemented. One of the things that we're seeing right now that the administration is floating is basically the dramatic change, almost a doubling at the highest rate of the marginal tax rate for capital, for long-term capital gains and so forth. Who knows what comes out of that? But the trend is clear that there was an old regime where that was kind of stable or going down, and that's not the case anymore. Regulation as well. There's a lot of examples we could cite, but I think it's kind of safe to say that under the new administration, it's quite a change in terms of more spending going to the IRS, more spending going to regulatory entities and so forth. There's kind of a tone that business needs to get I don't know if they punished, or wealthy people need to be examined closely. That's not exactly going to make this capital that seeks out higher returns, doesn't exactly give you the warm and fuzzies. That could be the kind of thing that really sets off people's incentive to go perhaps find better homes for that capital. And if enough people reach that conclusion, then that could start a very meaningful kind of change in flows, which impact asset prices, which is really what we're talking about here. And so finally, another aspect of this, if you think about where, again, where we were, let's say a few years ago, the idea, rightly or wrongly, was that the market was allocating scarce resources by, through this functioning of the price mechanism, but there's a lot more things at work now. We've talked a little bit about this environmental and social governance kind of movement that we'll talk about, in a little bit, where people are adding kind of more contingencies to the things that they care about, where before maybe it was just the bottom line in terms of, how much money was a company making or how fast was it growing. We're now kind of interjecting a whole set of fuzzy objectives into that market, and I'm not saying that's good or bad, but I would say this is that if your goal or if your framework is to kind of let the market hit some of the more efficient outcomes by letting it do its thing, we're starting to gum up those works. And the more we gum up the works, in my experience, I think that that tends to lead to lower returns, lower growth, a whole host of things that can make the U.S. less attractive on a relative basis to other opportunities in the world. So we'll talk about that. So to a couple examples of deglobalization. I mean, it sounds funny, right? Toilet paper shortages. It was one of, I think, our first communal experiences with with COVID. And then what we show at the bottom is, gas lines. I think it was only recently there was like a hack job that got done on the Colonial Pipeline, which really kind of set off a bit of a panic up and down the East Coast in particular, as people kind of rushed to fill their tanks with gas. Because the truth of the matter is that the average gas tank might hold, might be half full at any moment. But when everybody gets prompted to kind of go maybe buy a little extra gas, and everyone starts trying to move around with a full tank by topping up, then you quickly run out of inventories. I mean, so we're really kind of shifting, I think, from a world that you could describe used to be run by this just-in-time kind of inventory system. Certainly that I learned about like a million years ago when I was an MBA at Wharton, in terms of people trying to have, the goal of that was to have higher returns on capital by having less kind of excess inventories that were kind of clogging the system up. And there was this ruthless focus on efficiency, excuse me, to get inventories down as lean as possible. Well, those days, I think, may be past, because we're seeing these crazy kind of hoarding dynamics and these huge changes in inventory swings due to supply disruptions. And so there's been many examples of this where we're kind of dealing with a scope of uncertainty and shortages that we never really, seemingly were never this important before. And I think that's a pretty meaningful and profound change.
Yeah, Lewis, I was gonna add that, I mean, the shortages are really profound in so many different areas. I mean, we're seeing them in technology and the semiconductor space, and that's of course impacting the chains of things. The automobiles can't get semiconductors, so there's shortages in those, and then in construction equipment. And one of the things that I found in my personal research on the home builders is the home builders are not only having trouble finding lumber, but they are having trouble finding appliances, which I think relates back to some of the, it's just all across the chain. And of course, you're seeing it in labor now as well, especially in lower wage labor, where, as we're talking about in some other areas, the labor force is being paid in some cases more to stay at home, and that's creating shortages for them at work.
No, those are really important trends, Evan. We'll definitely talk about that. But I don't know. I mean, one of the reasons, this seems a little bit like a soft topic or something's really squishy, but actually, in my experience, we wanted to share with you one of the things that we're trying to do is that it's been my experience kind of as a cyclical investor that at the end of a cycle, everybody can kind of succinctly name whatever that most powerful dynamic was that was driving the markets. Because at the end, the belief is total and people understand the trend. But at the beginning of the trend, it's very, particularly if a trend change, it's very difficult for people to describe this succinctly. And so this is one of the aspects that we as a research team will actually think through quite a bit, which is kind of how is the world is changing? How could we simply define this? And is this likely to be the kind of market narrative going forward as the world changes? We think it's always been our experience that that's a very powerful insight you can come to if in fact you can be successful at it.
So Lewis, we got a question from Jeff, and I thought it'd be a good time to interject with this one since we're just from the last slide. I know we're going to cover it in a moment, but Jeff's question was from the prior side, what does ESG mean? Jeff, ESG really stands for environmental, social, and corporate governance, and is a new sort of standard that a number of investors are looking at when measuring sustainability, societal impact of an investment into a company or business. So it's certainly a new trend. The trend is picking up, and we're seeing a variety of firms adopt this for some of their investment products. We're starting to see it have impacts on things like Bitcoin. If you noticed, a lot of the movement in Bitcoin last week sort of was accentuated by some major companies and firms leaving Bitcoin because of the ESG factor. So they believe that it affects sustainability because of the amount of energy needed to mine Bitcoin. So from that view, we're focusing on it to understand how it impacts where we are in the new world.
Yeah, that's a great point, Bill, and thanks for clarifying that. And I think a bigger picture item in terms of thinking back about kind of the concept we're trying to lay out here is not that ESG is wrong. Certainly, this focus on environmental and social issues and governance, as you were saying, it's a different issue. It's becoming more important, But one of the things, again, in my experience, is that the more these items kind of encumber what used to be the market's, free and easy ability to kind of allocate resources, then that kind of economic engine of price discovery and resource allocation starts to gum up and work a little bit more slowly. And so this is one of the things that have to drive us as investors allocating people's capital, because it certainly drives, or it can drive in many ways, asset prices. Another aspect, I think, of how the world is changing is here we've kind of turned it kind of a unipolar world, and kind of what we mean by that is that now changing. After the kind of collapse of the Soviet Union, 1989, 1990, the U.S. in many ways really was kind of the sole superpower, the only game in town. Clearly, if you've been watching the newspapers and seeing the news, there's a darker tone and more of a bit of rivalry that's starting to emerge between us and our Chinese friends. And certainly China is, in many ways, a budding economic rival to the U.S. in terms of the size of their economy, the scope at which it's growing. And just one thing, I guess, and we'll see how this changes over time. Just one thing I would add, again, kind of being a cyclical investor in this area for a long time, there are many ways that, say, the Chinese economy is growing into a rival. It's just that the size and scope of it, it's really hard to kind of get your mind around. So some of you may know I was a very active investor in the steel sector beginning in 2003 to about 2008 or so. But one of the things that was remarkable about that time period was there was a good 2 or 3 years in a row where every year China was incrementally adding the entire cumulative U.S. steel supply that it took us 300 years as a country to build. They built that new every year for 2 or 3 years in a row. So I'm trying to remember what the exact number, for instance, of Chinese steel production is right now. I believe it's somewhere about 800 or 900 million tons, which is about 8 to 9 times what it is in the U.S. And so, these are staggering numbers. For the longest time, the U.S. was dominant in almost every category of kind of economic activity or production, and that's just simply not the case anymore. And so, we're all going to have to kind of figure out, what this changing economic aspects mean. And it's not just, frankly, China. If you take a look at Russia, which has kind of been a strategic rival for the U.S. for many years. These higher crude prices, frankly, are a boon for the very energy-dependent Russian economy, which, frankly, got cut off from the global, trading system by U.S. sanctions a number of years ago, and fought hard to get that economy restructured. So as the cycle changes, we're going to see kind of different, winners and losers in this, and it's our job as investment analysts and managers to try to figure out that change and invest accordingly.
Hey, Lewis, I was just looking at. Apparently this Putin-Biden summit that was announced yesterday is the first time that we are giving the Russians a unilateral summit since 2007.
The unilateral summit, you mean it was just us and the Russians at the table?
Yeah, I mean, Obama talked to Putin several times, but always on the side of some other multilateral summit. And I think it's because the U.S. authorities really understand that with these hypersonic missiles that the Russians have and the improvement in their economy, and their situation with gas into Germany and Europe, that they're a formidable power still, or again. And you saw just yesterday that the Russians are now laying the last bit of the pipeline in German waters in the Baltic Sea, this Nord Stream 2 pipeline that we've been vehemently against, and the Germans and the Russians have gone forward without it. I think without us, and I think that may not have happened a decade ago.
No, that's a really good point, Jeff. I mean, I think sometimes as an investor, this is one of the fun parts about investing. It's also one of the challenging parts, right? Is there all these moving pieces, and and again, I guess in my experience, I've come to this belief is that there's really only one or two defining powerful trends that are underway in the world at any point in time. They have many different manifestations, and that's why it's so difficult to kind of discern these changes at an early time. This is one of the things that makes investing interesting, is also vexing. But this is certainly the pattern I think that we're seeing in many ways. In fact, as we go to the next slide, we'll demonstrate how we're seeing this in other areas as well. You wanted to demonstrate, perhaps a visual image of some of the way that government intervention is kind of changing. I know as a research team, we've discussed how it used to be that we had these, targeted, programs that were temporary times. I think Zev and I were just discussing this earlier, the cash for clunkers, deal under the Obama administration after the global financial crisis, which was an auto stimulus package where basically if you turned your car in early, there was some kind of economic incentive to do that. So it was targeted to benefit automotive. But if you take a look at kind of the scope of so many government activities, and it's not just the central banks, or in terms of what governments are doing in terms of I guess really the list goes on and on. It just, maybe it's just me, but it seems different. It seems like the tenor now is kind of, it started off temporary, and now they seem to be enduring more, and perhaps they're permanent. But these are just incredible scope of changes, and it's happened so fast. One of the things that's difficult, to do when you are in the grip of great change is to kind of be able to put it in the proper context. And it just seems to me like the whole set of permanent government kind of guarantees going toward the common theme in all this, to get back to that point I made earlier, is if we're creating an incentive system that is not kind of yielding the fastest growth or the highest returns, you're going to have a less than optimal economic output. And it could be that for social reasons or different priorities, societal reasons, that's what people want. But the market's not really good at those things. I mean, the market is really good at allocating resources. Excuse me. So to the extent that all these forms of kind of interference or societal goals that are starting to layer in on top of that, in my opinion, you need to kind of get ready for suboptimal economic outcomes, less growth, less demand, for the dollar, less rewards for people's investment capital, and with the market always changing, that money tends to move to seek out higher returns in the kind of environment where it is appreciated and rewarded. And it just seems like this is another example of the U.S. perhaps starting to turn away from some of the more independently minded frameworks and philosophies that had guided it, and frankly led to really dramatic capital outperformance. If you take a look at the U.S. market relative to the rest of the markets, this is my view on this anyway.
Yeah, I was going to note that. I mean, there on one of those points, there's unmistakable shortages in labor right now in a lot of industries, a lot of parts of the country, and yet we're continuing to give extra unemployment benefits. That's something that I don't think would have happened a decade ago in the financial crisis. And on that last point, it's interesting. My wife works for a public UK company. We were talking about ESG before, and she was just telling me the other day, she's a lawyer for this UK company, and the amount of time that she spends on D&I, which stands for diversity and inclusion work, has just exploded. It takes up an inordinate amount of her time compared to what it used to. So yeah. These are like real, impacts on companies and their efficiency.
Well, and one thing I would add on top of that, I mean, we're not saying these changes aren't real, these changes aren't necessary, or, we're not taking a view on that. We're taking a view that, is this helping the market do its job more effectively or less effectively? My experience has been that, the more non-economic tasks we try to heap upon its shoulders, the less freely it's going to operate, and the worse the outcomes. And so this is not a judgment. This is better or worse. We're just saying that that's likely to gum up the action of the market in terms of its ability to do its job, and that tends over time to lead to suboptimal.
Yeah, I wasn't saying she was complaining about it. She was just
no, for sure. But that's definitely another aspect of the kind of change that we're seeing take place here. And I think Bill had the great example of Bitcoin in terms of kind of that seeming to fall out of favor due to people's overnight discovery that it was highly electricity intensive to mine Bitcoin. But that's one of the funny things about the market is people don't care until they care, and so you never know when they're going to care, but they're caring now about an evident truth. It's one of the endlessly frustrating things about the market. We talked a little bit about this idea of kind of de-dollarization, and here we just wanted to kind of demonstrate what that kind of meant in terms of scope of activity. So the graph on the right, we show central bank balance sheet growth, and so what this basically shows is, let's say, pre-COVID crisis, the central bank balance sheets, which are really kind of a way to kind of show how much kind of essentially interference or support, depending on how you look at it, these central banks have provided to their own economies. And so starting from the base of 1, you can see that all of the central banks that we demonstrate on the right have had pretty meaningful growth. Two things to that jump out at me. And so what that is clearly an example of is governments really feeling like they need to step up their activity in the markets. Now, one thing you can see in black is the U.S. Federal Reserve. So we have dramatically outpaced the scope of activity, and frankly, we continue to outpace the scope of activity of kind of some of the bigger economic rivals or some of the more well-known kind of entities out there. That's number one, and that is frankly at some point, if the dollar is like any other commodity, if you supply too much of it relative to demand, the price goes down. And so this, and again, if that trend were to be sustained, that could easily set off kind of a shift in fund flows. And you have to understand that the global asset markets are hundreds of trillions of dollars in size, and a little bit of shift in terms of perception or how people think about where their money is going to be rewarded the best can send off a very meaningful shift kind of in asset prices. This is one of the things that we really think a lot as a research team. Now, the second point I wanted to highlight, if you look at the bottom on that chart, there's an item in yellow, and that's the change in the Chinese central bank balance sheet, and it's almost nothing, which is frankly interesting because one of the things I think we want to be alive to in this whole process is if we do have this potential rise or threat of China to arrival of the U.S., then we have to take a look at that market and potential flows. And I can share with you one thing. This is fascinating. I was listening to in a podcast the other day from an investing genius, Stan Druckenmiller, who's got one of the best long-term investment returns, frankly, of anybody on the planet over a very long period of time. And in that podcast, he shared a bit of data that was frankly new and real shocking to me anyway, which is that basically that as much as, let's say, 20% of the global economy may be made up in China in terms of a purchasing power parity basis, which is just kind of a way to a lot of people adjust for relative relative economic growth or size. But so anyway, so China was almost the size of the US on this adjusted basis. But in terms of their presence in the currency market, excuse me, not currency market, the asset market's only maybe 2% of the global market capitalization of equities and bonds, were in China. And that was frankly a shocking number to me because in the US, we're far more well represented due to our long history of clear and great governance, and a whole lot of the institutional infrastructure that has made the US kind of what it is. So the reason I'm highlighting that is if China is to take this more kind of aggressive or frankly role to rival the U.S., you would anticipate that one of the things that might happen with that is Chinese asset prices could appreciate fairly meaningfully as we get a more of a rebalance in terms of the size of their market kind of reflecting the size of their economy. So this is one kind of potential theme that we're kind of thinking about and evaluating as we think about how the world might change.
Yeah, Louis, we should also note that this is showing central banks and monetary policy. And if we showed a similar chart for fiscal policy, government spending during COVID, it shows pretty much the same thing. And it's important, I think, because we've always been known as the country that did less intervention during times like this, in the great financial crisis and the '91 recession. Europe's always, particularly Europe and China as well, have always done more, and so this is really sort of anomalous and somewhat troubling for our view on the dollar.
Mm-hmm, mm-hmm. Definitely. Well, now, let me take a step back. For those of you familiar with our kind of investment and risk management philosophy, you understand that we believe that our job as a research team doesn't end when we kind of identify problems or things to be concerned about. In fact, we've joked a lot internally that I'm kind of the chief worry officer here at the company. But I think successful investing, at least as we think about it, particularly on a risk-adjusted basis, really has to do with thinking about both the opportunities and the threats that we kind of see in the marketplace. Things that if they happen, they're not frankly great, or at least they're not great for the way that assets are priced, and people might be thinking about the world right now. But our job really goes beyond that and say, look, what are the problems, number one, but number two, importantly, what are the solutions to those problems? Because solutions are how society progresses. And if the market's job is to allocate resources, the market's job is to reward and find the companies and businesses that are solving important problems and to help those kind of fulfill that role. So if we have kind of identified to at least our framework that we think that there are a number of reasons why we might be leaving the former environment, that what we've defined as the old world. What's that, what might the new world look like? What would be the investment solution to some of these potential problems that we're outlining? And so that's really what this chart is about that we wanted to share with you. This is from an old friend, Barry Bannister, who I've known for more than 20 years, mentioned his name and featured his work on these past market happy hours. He's a brilliant thinker, the chief market strategist at Stifel, excuse me. And in this chart, which goes back, I think, goes back a couple of 100 years. Let me kind of walk you through what he demonstrates. But basically, you can see there's a very strong relationship between two things, almost identical actually, over a very long period of time, 200 years. And so what it demonstrates is how closely aligned and related two factors are. The first is the outperformance of what we would call value stocks or value sectors. And those tend to be what we've discussed, old economy, kind of bricks and mortar type businesses, and some of which are found, let's say, in the materials or the energy sector, things that benefit from a little bit faster growth and frankly a little bit weaker currency. It shows that performance of when the black line's going up, this is value stocks outperforming growth stocks. And of course, you can see that we're at one of the lowest levels on this is a rolling 10-year period for like 200 years. So that's a big deal. What's remarkable is how closely related that is to the changes demonstrated in that red line. And what that red line is the rolling 10-year return for commodities. And so so I think the point that Barry is making here, that certainly I want to be very open-minded to, is that you know, we seem to be, I think this a few months ago, but you know, we seem to be at a very extreme level in terms of returns over the last 10 years. That it's been massively growth dominated. Value's frankly been a disaster, which has been painful for you know, me as a value guy, and I think painful for Sev as well. You know, number one, and of course it's been an abysmal period of time to invest in commodities. With our view that the world changes quite a bit, and we think in terms of cycles, it makes perfect sense to us. You know, number one, that these two would be closely aligned, and that we are at an extreme level where it would be reasonable to expect for value to perform much more strongly. You know, number one, and for the newfound strength in commodities, frankly, to be sustained. That is certainly my expectation going forward. The market may have its own view on that. We'll see what takes place. But certainly when I take a look at the work that Barry's put together here over a 200-year period, showing that we're pretty much at an all-time low, and that when these cycles do change, and perhaps changing now, we'll find out in retrospect, that change tends to be very enduring. The last one of these that we saw basically was a 10-year phenomenon from, you know, 2001 to 2011. So we're very open and very alive to what could be, you know, one of the most meaningful, you know, changes in asset price leadership, and what would be future market leadership. The biggest change, frankly, in a decade or more. And you know, getting a question like this right is really important for us as a research team, because remember, what we're trying to do is we're trying to invest in solutions. And so it might be that many parts of the market, excuse me, might view some of these changes as bad, because the market right now is really more dominated by, you know, growth type investments, not really value investments. And commodities have had until recently just an abysmal run. So the companies that would benefit from this change, were it to happen, are a tiny portion of the market. So this might possibly create a challenging environment for people who are invested in the market. You know, thankfully, the flexibility of our mandate, you know, gives us confidence that if we need to change our investment profile, which is frankly underway right now, which is why we're kind of having this talk, that we have the tools necessary to invest in that broad world. But what we're looking for, make no mistake, is we're trying to invest in the solution providers that can profit in, you know, that new world that we think might be unfolding. So we wanted to just put a finer point on this. You guys have been patient with me. I've been rattling on for some time now. We just want to give you a couple of concrete examples in terms of, you know, what does this mean? How is this changing in our investment portfolios? So if you think about, so we just wanted to do a side-by-side contrast for you in terms of the general scope of how we were kind of positioned in terms of the investments that we favored and how it changed. So in terms of the way that, you know, one way that we used to be positioned, many of our portfolios had a large investment in what we call staples. And so, you know, staples are, you know, everyday kind of household items that people buy, you know, day in, day out, no matter what, you know, the economy is doing. And the reason that we own those, frankly, and we had that was a key part of our investment portfolio for 7 or 8 years, honestly, is that was very much tailored to the world that we believed we were in. We believed we were in a slow growth world where the dollar would be strong and it would kind of suck energy, frankly, from the international marketplace. That would be kind of bad for commodities and abysmal for commodity related equities and everybody that kind of served that ecosystem. You know, number two and number three, we felt like as commodity prices were rising, a company like a staples company, one of the things that you could say defines it is has kind of a stable top line, and then the costs were falling as raw material prices were falling. So it was frankly a very kind of defensive way to profit from the environment that was unfolding, and I believe this served us very well. You know,
Lewis, I would kind of say that goes to trade structure as well, in the sense of, you know, taking advantage of something that's going down. You know, certainly many people use the method of shorting, which is a very timing intensive way to do it. So I think in our view, when I think about it, is like invest in something long that will act like a short or benefit from falling. So as you're thinking of a strong dollar, lower growth, falling commodity prices, the staples really benefited from that. And then that kind of now what we're hearing is that reversion is underway, and commodity inputs are growing in price dramatically. And as a result, we have to make a shift in the portfolio.
No, that's exactly correct, Bill. Is that it's a really good example, in my opinion, about how we go from kind of a an investment idea or a notion about how the world is changing, and say, okay, what is an intelligent risk adjusted investment structure that we think we can set up that avoids the being on the wrong side of the changes we think are taking place, then it can actually profit from them. And so that was very much a key aspect of so many of our portfolios, and that's changing now, and it's changing now, and we're making these changes because we believe that the world is changing. And so even though that we think was a wonderful way, particularly on a risk-adjusted way, for us to kind of express that view for 8 years, that view has changed, and so the portfolio is changing.
Yeah, and I think from a trade structure perspective, it works both ways in a cycle. So I remember back several years ago when crude prices were $120 a barrel, and we were trying to figure out, as commodity prices beginning that strong dollar sort of run, what was going to happen with commodity prices, and we felt strongly that they were going to lose value in price. So we invested in an airline in order to benefit from that, because if you think about it, the airline is a basket of planes that has 46% of its operating cost in fuel. So investing in something that benefits from either a commodity going up or down is really an interesting way to look at it, and also to manage risk.
Yeah, it's all true, Bill. As you know from kind of our long discussions on this topic, to successfully run, I think, an investment program, you not only have to have, I think, a reasonable framework for how the world might be changing, but you have to find the right investments, and that's really one of the things that makes, I think, investing such a challenge is you have to kind of understand the world, and then you have to figure out what are the best 2, 3, 4 investments in the world that not only sidestep the bad stuff basically, but that we can identify anyway, but the benefits from it kind of when it happens. I mean, and when those kind of threats change, then our investment philosophy drives us to make changes and find those appropriate, trade structures, the companies that help us benefit from the things that we see taking place. And another example, many of our portfolios, I mean, we've been investing globally for decades, but many of our portfolios, we made the conscious decision back in 2011 or 12 that many parts of the international marketplace, we didn't want to be there, because our view was that kind of a strong dollar would suck all the oxygen out of the room, which is kind of what happened. Excuse me. But if those trends are starting to reverse, then it gives us, frankly, a whole wider palette, for us to choose from as an analytical team, which I think is great. I mean, and this is just me selfishly, trying to be able to go back to, these esoteric kind of interesting things as a kind of fundamentally driven, stock picker. I love to find some idiosyncratic stock here or there where something, really interesting is going on that's very much off the beaten path. That's where I get a lot of enthusiasm and energy for this business. And so, it's really kind of exciting to have this kind of new slate of what we think is investment opportunities before us. And another aspect of, generally speaking of a lot of our portfolios in the past is, aside from, let's say, some precautionary positions in the precious metal sector and gold sector, we really had very limited commodity exposure. Because not to repeat it, but as frequent kind of followers of our research will understand, we believe gold's a really important leading indicator for commodities. When the gold price is going down, it was very easy to look at the commodity world and say, we don't want to have any exposure to investments that make commodities, for instance. And just by way of example, I think as late as, was it 2012 or 14, Zev, was energy 16% of the S&P? That number is sticking in my head. Does that sound right? You're on mute there, Zev.
Sorry, yeah, the fall off was in 2014. So
Was it 16%? And it got down to what, 1.5 in the
yeah, and obviously it was a bunch higher even before that, and it was inching down, and then in 14 the price really fell, and so it went down. But yeah, it was in the mid-teens for sure.
Yeah, well, so it's incredible. That's an incredible decline, and now that, energy is tiny and kind of people are giving up on it, we think it might be interesting, and that's kind of what those charts from Barry kind of demonstrate, right? So, so finally, the point that we wanted to talk about, we talked a lot about, changes within the portfolio, right? It's kind of like, why now? Because, clearly we're making a lot of these changes now, and frankly, we're not done yet. There's going to be more changes. It really comes to this issue of tax, and in just a moment, I want to hand it over to my partner Bill, who has wonderful expertise in this. He can talk about this, but you don't have to be a tax expert like Bill to understand that things are changing. If we are talking about doubling capital gains tax, and it may be making a whole host of changes on other estate taxes and so forth, that this is not a capital friendly environment, at least not as much as it used to be. And society, and voters, they want that's fine. We're not saying that's good or bad, but we're saying that's going to change people's incentives. It can change capital flows. It can spark changes in the market. And we would not be doing our jobs if we weren't being alive to that, figuring out what those changes are and what change and how we needed to address that. I mean, can you talk a little bit about that, Bill?
Yeah, we've been spending an enormous amount of time with our clients and friends talking about the proposals that are out there. Some of them are more traditional that we've seen over and over again, depending on who's in control of the Congress and the presidency. Things like ordinary income tax rates going back to the level prior to the Trump tax cuts, or corporate tax rates being adjusted up. Those are sort of normal, types of changes that we see based on administration changes. What we haven't seen, and even in that same vein, the reducing or the increasing the unified credit from an estate tax perspective and dialing the rate up or down, those are things that we've seen over and over in my career over 25 years. What we haven't seen is really what I believe is the most fundamental shift, not only in taxation, but in tax structure, which is what we're looking at as the proposal for the capital gains tax situation. So the biggest issue, or the first issue, would be, while we're alive, the capital gains tax, obviously long-term gains going from where they are today at 23 up to 43.8%. And that is for individuals. There are two different levels out there. One is proposed at 400,000 of income and higher. One is proposed at $1 million of combined income and gain in any given year. So many families would get there in that aspect alone. But fundamental shift would be the change of capital gains tax rates at our death. In the current law, when we pass away, any of our assets that have embedded gains get what they refer to as a step up in basis, or a basis reset, which means that the tax cost basis of your asset steps up to the value that it was the date of death. So if you had a building that you owned that you paid $100,000 for and it was worth $1 million at your death, that $900,000 embedded gain gets wiped away under the current law. Not only are they projecting to take that away, couple that with the increase in the rate to 43.8, but the fundamental shift in tax structure that hasn't been talked a lot about is really a shift from where we were to more of a Canadian style system. So under old proposals around capital gains tax and stepped up basis changes, the thought is that the basis would stay and carry over. But if my son was Lewis could hold that asset and only incur that gain when he sold the asset. Under this proposal, they're shifting it to a transfer tax. So all gains would be due upon transfer. So you think about structurally from an estate planning standpoint, you pass away, your assets transfer to your heirs. At that point, the embedded gain tax gets triggered at 43%. And then 9 months after the date of your death, the estate tax is based on the value of the estate at your date of death. It's unclear whether they're going to give any credit for any capital gains tax paid or not. So it's going to basically include a dramatically higher number of people in transfer taxation at death. There'll be a $2 million exclusion, and there'll be unlimited transfers between spouses. But really, it's going to lower, in my view, the estate tax threshold or a transfer tax threshold down to $2 million. So huge, huge issue there. Simultaneously, hidden in sort of the fine print of this proposal is that they're going to create a transfer tax even during your lifetime. So if you gifted a building to a GRAT or to a trust, the embedded gain would be paid. If you gift an asset to your child, the embedded gain would be triggered at that point. So it's going to dramatically affect the opportunities that we have for gifting, dramatically change the ability for us to move assets around. So we are really focusing on this. If you haven't had an opportunity to look at this and how these changes may affect your overall planning, we're happy to sit down and talk to you about it, but it's certainly something to take seriously. If we couple that with the changes that have been made or proposed for the estate tax, and the existing IRA restructuring that happened in 2018, it really could be a huge impact on families. So I would encourage you to take a look at it, understand what the impacts are in your estate. We can walk you through that very, very easily. And we've been doing that on a regular basis. So if you have that top of your mind, we'd be happy to sit down and talk to you about it. But certainly, as Lewis, as I've been saying, it is truly the largest shift in tax policy that I've ever seen in my 25 years.
Well, all I can tell you is I'm thankful to have a partner that is an expert in something that is so incredibly important to investors.
Yeah, and when we look at this slide, Lewis, it's really interesting, and that Lewis actually shared this with me several weeks ago. But this is an historical look at the U.S. marginal tax rates versus government debt, and you can really see how they've moved in history. And if you look at the right side of the chart, you know, this is the biggest divide that we've had historically between the two. So the likelihood that that these taxes are going to be increased, in my opinion, is very high. I think the Democrats are going to have some debates, and they're going to allow the Republicans to have input. But at the end of the day, they can pass all this through reconciliation. The spending aspect of this is being tied. So what you're seeing is they're dividing up the tax proposal and tying it to certain aspects of it to spending initiatives. They're saying, hey, we want to spend this amount of money, and oh, by the way, this capital gains tax will pay for it. So again, very, very much in my view, I think we have a high probability of many of these coming into effect. So important to really look at that from a planning perspective. It's also something to think about is when these are going to take effect. When we talk about whether we take gains this year or next year. So we'll be monitoring that. We're going to update our publications and keep you up to date on what's happening from a government standpoint, so we can get ahead of it from planning toward the end of the year.
Well, I wish I could tell you that I understood half of what you just laid out there, Bill. But it's clear that
real simple.
Taxes are going up.
Our taxes are going up, and the tax structure is changing, which is going to make it harder for families to move assets down to future generations.
Yeah. So clearly, you know, I mean, our clients are wealthy individuals and their foundations and so forth. So, you know, this is an issue for real people out there. So if there's any way that you know, that our team can help, and thankfully we've got Bill's knowledge and that of a deep staff of people to help understand this, you don't hesitate. You know, we're going to reach out. That's what we're here for.
So, Lewis, while I was talking, we did get one final question from Robert, and his question is: as demand exceeds supply for homes, autos, computer chips, home appliances, and many other commodities, yet the Fed seems to continue to say inflation is under control. Do we have a thought on that?
Well, sure. Well, you know, so I guess what I would say with this is that you know, the Fed, and it's not just them, it's kind of policymakers almost all over the world, with interesting, like the notable exception of China, seem to think that, you know, more government is a solution for this, and part of that is a central bank activity, and they've committed, and I can only take them at their word, that they're going to kind of keep this unusual amount of accommodation present for, you know, many years until in their opinion we're kind of past some of these COVID related issues. So you know, not to have a big long debate, but a key aspect in terms of whether this becomes like something like 70s inflation, we don't believe that's going to be the case. Now, markets may prove us wrong, but we don't believe that's going to be the case. We've mentioned in the past a brilliant bond gentleman, Dr. Lacey Hunt, who writes at Hoisington, who you know, we have, you know, since we met him 12 years ago, believe he's the smartest bond guy in the world. And he has a view that I won't try to parrot here, but I would say that over indebtedness is essentially another form of tax, and we have a tremendous amount of debt in the world, and I think this is going to be a problem for growth. So I do think that kind of limits the potential for, let's say, runaway inflation, but I do believe that this is going to change the mix of winners and losers in the market. And frankly, I think the general market cap as it's set up right now is weighted very highly to last cycle's winners. And what we're outlining is our perspective that perhaps last cycle's winners won't be next cycle's winners. We think this is one of the benefits of having active management. I think this is one of the benefits of being able to communicate with our kind of clients and friends like this in terms of what's going on in real time. So I really think those mix changing. And you've identified, certainly a number of these kind of commodity chains where there are companies involved whose frankly lives are changing in a very positive way due to these higher prices. I mean, they might be bad for certain consumers, but they can be very, very profitable for the companies that make them and for investors in those companies. So we're focusing on identifying those solutions. So no question that looks like that's perhaps a change, but frankly, this is kind of what we get paid for, is to understand this change, identify ways to kind of profit from it, and to try to to navigate these things one investment at a time.
Thank you, Louis and Zev. I hope everyone found this afternoon's presentation helpful. We look forward to seeing you next month. Keep in mind we're still publishing on a weekly basis, and we hope you're consuming those and enjoying those pieces. If you have questions along the way, feel free to email us, and we hope everybody stays healthy and enjoys getting back a little bit more of an active life. So we'll look forward to seeing you next month.
Bye, everybody.
Long.